On the call this morning, we're fortunate to have my guest, Jason Yarusi. He's the half of Jason and Pili Yarusi. They are investors and fellow podcasters. They have the REI Foundation podcast. It's the REI Foundation with Jason Pili, and they're based in New Jersey. And today we're going to learn about their most recent acquisition. They bought a 94-unit apartment complex in Kentucky. So with that, Jason, welcome.
Thank you very much. Good morning. How's everything?
We're good. I'm excited to have you here and learn about learn about you and also about your most recent acquisition. I think it's an interesting story. A little bit I read there on your Bigger Pockets post, and so I'm excited to get into it. But before we do, I gave just a very, very brief introduction about you. If you could share with the listeners and myself a little bit about your background.
Sure. I grew up in a family that was, I would say my dad is entrepreneurial. He comes from a very large construction family. And so we go back about 5 generations of construction. And at one point, my father had the idea that he wanted to jump in there and move himself into just actually moving buildings and raising houses. And it was something that we factored in that it was just an interesting route because no one here in New Jersey was focusing on that. It was something where he said he saw a niche and people were asking him to shore buildings and move a building at one point and then actually lift the home to correct the foundation. And he just said, well, I'm out here chasing around trying to do framing jobs where everybody else is a framer. And here's this niche that I have the opportunity to move into. And he started the company from there, and that's been about over 40 years ago now, and we've been raising homes ever since. And with the influx of storms that have come up recently, we had Hurricane Sandy, before that Hurricane Irene over here that hit the Jersey Shore and, of course, the East Coast pretty hard. We've raised somewhere around probably 15 or 1,600 homes in the last 4 years. So it's been pretty, we'll say busy, for lack of a better word.
Wow. I'm just like 15, 16. That's a big number, and so about 400 a year. Is that? I mean,
yeah, and it's a big number, but in the matter of impact that actually the storm had, it's almost small to all the work that has to be done here. And there were so many homes here that were impacted and flooded out, and so many homeowners that are still out of their homes today or are back in their homes and still have to do something to make their home FEMA compliant. That is, there's still a ton of work to go. Where you're going to have starting in about a year, the flood insurance rates are going to start increasing for residential and commercial properties at a rate between every year for 4 years and every year for 8 years, where it's going to start increasing 12.5% to 25%. So if you have a house that's built below the deemed base flood elevation level that's set between FEMA and the towns, your flood insurance is going to be dramatically high. It can be $3,000, in some instances could be $30,000 if you don't do something to make yourself compliant. And the thing we do is through either basically homeowner financing and private financing, or through grants or through insurance money, we'll elevate these buildings and make them FEMA compliant, and we'll see that flood insurance rates can actually be cut dramatically. In some instances, we'll take a house. We actually just did a flip ourselves. We lifted a house, and the flood insurance went from $6,000 to a little between $6,000 and $7,000 a year down to $400 a year.
wow,
So that savings
huge.
you can make your money back within 10 years based on a 30-year mortgage.
No, that's huge. Fascinating. And just as a side note, as an insurance broker, I know what you speak of. I know out here they've been redrawing the flood maps, and I think it's basically just a combination of technology. They're able to more accurately recognize if a property is in a floodplain. Whereas before, I think it was kind of a good guess, if they were in a low-lying area, and they had reason to believe that was the case. But interesting. I'd love to talk to you more about that, and maybe we can do that offline and talk more about
Sure.
how that impacts. Because I'm certain, in fact, I've had episodes on the podcast here before where we've talked about flood insurance and just I think there is a need to understand that, because I know I actually had a commercial broker pretty upset with me because of the cost of some flood insurance on a deal he was trying to sell, and it basically killed the deal.
Yep.
But it's important to know if you're buying and you don't know that you're in a flood zone, or the cost, it can really screw up your numbers there if you're looking at big flood insurance numbers.
And if you're not paying attention to the increase in your premiums, that's about to come up. But there's a lot of ways. I mean, you don't have to go out there and elevate your building. So if you're sitting here listening to this and saying, no, oh man, I got a 100-unit apartment building out here, and you're not going to displace 100 tenants just to go and raise a building for 6 to 10 months of trying to get this work done. There's a bunch of basically dry proofing or wet proof or damp proofing the building that can cut down your insurance costs pretty dramatically. There's other things that you can do. You can build retaining walls. There's a lot of other factors that you can look into to make your property compliant and reduce your flood insurance costs. You can move your mechanicals out of the flood area, move them upstairs. There's a number of different directions you can take it that you can actually help them, and that's ultimately going to help your bottom line in the end run.
Cool. All right. Well, let's well, thank you for that how you or your background there and stuff. So let me ask you. So you've clearly been around real estate and moving buildings and stuff. Have you been investing before this 94 unit complex, or was this?
We have, and what we've done is we've actually used the house lifting to our advantage, where we will actually take a house and lift it up and put it at a safer plane, make it FEMA compliant, put in a new foundation, and either put it back on the market, because now it's not something that's going to be a huge undertaking for the next homeowner to come in. We've done that work up front, and that increases the property value over top. So we've actually even not in floodplains have raised properties, and that may just be a ranch and added square footage, whether or not it would be sometimes we'll actually raise it up, and so we can save the roof line. We'll build a whole story underneath the property and make it a two-story property and just flip-flop the footprint. So we've done a lot of that to our advantage. Those are a lot bigger undertakings, and then we've done smaller properties out of state, but those are, we'll say we'll do a lot less work on those and try and keep those minimal, just because it takes a lot when you're doing such a big project here.
Yeah. Hey, let me ask you just one question on that. Is there a maximum size of a building, square footage, that you guys are able to lift, or is there a limit on that? There's not. Really?
No. Wow. Yeah, we've done 20,000 square foot buildings. It really comes down to it. It's not so much the size of the building that matters. It's really the design of the building, the integrity of the building, and then the cost of the renovation. Because you get to a point here, if you have a building that's built on a slab that's maybe 15,000 square feet, and it's going to cost so much to raise the building up, build a whole new floor system throughout, rerun all the mechanicals, that cost may be more than the actual cost just to tear down and rebuild. Right. So it comes down to a cost analysis of whether or not it's more efficient and more price efficient or cost efficient to do the work versus knocking down and rebuilding. But what will happen sometimes is that they'll actually take it as our component, because if they did knock down the new setbacks, they may not be allowed to build the same structure in place, and they may not be grandfathered in to have the original structure as they had it before. Got it.
Well, it sounds like definitely you got to run the numbers to make the
Sure.
decision on what to do there. So up to this point, then you've been basically flipping. Is that what you're investing?
Basically flipping. We did hold some properties out of state that we held as rentals, and we had some in Indianapolis, some down in Alabama, and that was kind of getting our feet wet with out of state investing, and kind of fell into them. Had some friends that were doing it, and just ran the numbers. The numbers seemed good. They had a team in place, and we said, man, this is something, and slowly got our feet wet into that process of investing outside of New Jersey.
Got it. So what led you to doing multifamily then?
Well, we're realizing that the economies of scale of if we wanted to build basically a real estate portfolio, especially out of state, where we were trying to find a twoplex or a threeplex or a fourplex and grow our economies of scale and be able to have someone manage it and to see the return, it was just becoming hectic. You have one tenant move out on a two family out there, and then you're trying to carry on one tenant, or you have one roof for a two family, and we started looking at larger properties and saying, well, it's pretty much just the same work to have a larger property, but the economies of scale start to play in your favor. You have now, if you have a 90 unit or 100 unit, and you have one tenant out, it's not going to kill your numbers. You also now have maybe one or two roofs for those buildings. And there were just so many things that play in that factor that everything just started to click that was the direction we needed to go to.
Right, right. No, I've come to those conclusions that it's a whole lot easier. Like I think the thing I always heard was about the that percentage of vacancy thing, and until you have a vacancy in like a single family and you're spending thousands to rehab, and then you're out a month or two rent or whatever. I mean, it becomes real, when you see it that way. So, got it.
Exactly right. And if you have a single family home and you have a tenant out even for a month, or you just have some repair that comes in, I mean, that may kill your cash flow for 3 years. And for that point, it's a really big undertaking.
Right, right. So, learning the difference, was it basically were you learning based on having worked and owned some single families and duplexes, or was there anybody that you mentored you or that you learned from that said this is really the path?
Definitely. And once we knew that this was the direction that we wanted to go to, we just tried to suck up everything we could find, as much information we could find, listen to a bunch of podcasts where a bunch of you guys give a great knowledge on investing in apartments, started looking at areas that we really liked, and then started looking at other people who were doing it. And if there was one thing I could say out there is that we would not be at this point if we didn't reach out and start working with some mentors that actually gave us steps. And to us, I mean, we used the steps and we took the steps that were working for us and just really pushed them to get to the goal here. But without that framework, we would just still have this idea that we want to invest in large multifamilies. And I'm sure we would have gotten there, but I'm sure it would have been a lot longer of a process to get there, instead of just saying, okay, well, this is the steps they've taken. Let's see. It's worked for them a number of times, so why try and learn it ourselves?
Right. Well, so when you made the decision that you wanted to go and do the multifamily, what was the criteria that you'd set for yourselves as far as the type of property that you were looking for?
Well, to backtrack, one of the reasons that we didn't look in New Jersey is that, New Jersey is it's very expensive. The eviction laws are not in your favor. The returns are low. People will buy and they can hope for appreciation. All these things that sure could work out, could not work out. But we realized that while it worked for a lot of areas for flipping, it wasn't where we wanted to be or where we could focus and still meet the returns we wanted to get. And that's why we started looking out of state. Started looking at markets that had really population growth that was steady over the last 5 years, 10 years, 15 years, had job drivers, had job diversity, and had really one of the major points there is that although I was investing out of state, I was also looking in areas that I was familiar with, and I may not know street to street, but I had family there, I had friends there, I had people who lived there, and I've been there a number of times, or been there a couple times, to just have a grasp enough to understand the areas I wanted to start looking in and the areas I definitely didn't want to start looking in. And that brought us to Kentucky. And that was one of the first reasons that we said, okay, Kentucky's one of the ones that we're going to focus on. It was actually the third on the list, but it allowed us to start focusing there. And the one thing we started doing was building a team. And that was one of the major facts. We started talking to a number of people on Bigger Pockets, a number of people that we'd meet at meetings, a number of people that we'd get for referrals. And really it started with finding a property manager. And we will say vetted a number of them. And we had a certain list of criteria. And then we went around and from there had some recommendations on brokers. And we're telling them what we were looking for. And what we were looking for is that we knew that for the property manager to work in our favor, to be able to hire staff, have an on-site leasing manager, have a maintenance person, that we really wanted to be at 100 units, but like at minimum we could probably be at 75, and that was probably our direction. And then we knew on a high end 200 was probably as far as that we were going to look, just so we weren't competing with some of the bigger players and some of the REITs. And to couple with that, we weren't going to look into A class because A class there, A class in New Jersey, we were competing on a whole level that wasn't in our realm. We wanted to have something that we could find value in, and whether it be in inefficiencies in the management side or in something with the property. And beyond that, we were also looking for B and C assets, and preferably working class neighborhoods where if you look at rent over the last 30 years, you weren't seeing much dips in rent. And a lot of this information became available to me because I actually went to high school with a very good friend of mine. We were captains of the football team, played at school forever. And he went to the Marines after high school and got out of the Marines, started working in commercial real estate about 13, 14 years ago. And we were actually drinking beers in his backyard about a year ago and talking about what we were both doing. And we started talking about apartments, and we decided we were going to take this journey together. So along with Pili, my family, and Kevin came onto our team and really added a ton of value for him and I getting to the finish line in this first one.
Cool. No, I like your, the team. You mentioned about having the team in place.
Yeah.
You mentioned the property managers. Were you actively, were you going to them to find out if there were some properties that they identified that were potentially for sale, or?
Kevin brought a strong understanding of that. He worked for a commercial data analytics company. And so when he moved from being on the brokerage side, and he moved into really just data analytics. And for that, he speaks with a lot of these brokerage houses, speaks with a lot of the property managers. So he had a bunch of good questions that we went out there first. First, we wanted to know what they could handle. We wanted to make sure that if we were getting a property manager, that they weren't basically delegated to handle single family homes, or they only had 50 units under management, and all of a sudden we were going to ultimately double their units under management. So we found a company that had 5,500 units under management currently. They do all their renovations in-house, of course, besides maybe their licensed work like plumbing and HVAC. They delve primarily in the B and C asset range, and they're very familiar with the market. Like I knew it was up in Kentucky, so I knew areas I didn't want to be in, and they were right on top of it, and they had answers for all of our questions. We were very persistent. We wanted to make sure that the software they were using, we had real-time access, especially since we syndicated on this deal. We wanted to make sure that if we wanted to see what was going on with the financials on a real-time basis, we were able to see that through their platform, and that was something they also provided. And that was one of the first steps. We said, okay, this is a great partnership. On the same side, we were talking to a number of brokers, so we were getting some deal flow coming in, and they were very upfront with us, saying, "No, we hate that deal. This is why we don't go in this area because of this." And then they were saying that this is also a good deal, and so they brought this deal upon us. And the property actually had been on the market. It would probably be about a year and a half ago now, and there was an offer made on it. It was a pretty high offer, and the person who made the offer got into the property and ultimately retraded a pretty significant amount. The owners of the property, their father was getting very up in age. I think he was in his 90s now. So there was a couple kids involved, which I'll say kids, but they're probably in their 50s or 60s now. And none of them were in the state. So none of them were really actively involved with the apartment complex. And it just wasn't what they wanted to do, and they didn't really want to carry it on. So went off the market after that. It had just kind of sat dormant, just kept doing its thing, but no one's really been paying attention to the property. So the property manager said, "Hey, I know this property. It is something that I think there's a lot of value add to it. It still has very strong bones because the owner himself had built 3 of the 5 buildings. So relative in that point, it wasn't a ton of CapEx for maintenance, but it was being managed poorly. So he said, why don't you take a look at it? So we got the bare bones of the financials that we could get from it, looked at it, and we made an offer at the number that works for us, and we were pretty substantially apart, and it was just we were about $1 million apart in the offer, and they just came back at the price they had originally, which was the price that this other guy had offered, which was completely out of the box. And we just said, yeah, we just feel like we're too far apart, and just kind of let it sit for 6 or 7 months. And we were looking at other properties throughout the area, and just came back, and just I think 6 months came by, and we just looked back at that property and said, still a great property. Put back an offer that was, I think it was only $50,000 more than we were at before. It was, I think it was 2.15, And all of a sudden, those owners came back and had cut their offer $600,000. So we knew something that they were at least getting eager to the point, and that's where the process started. And over the next 3 or 4 months, we went back and forth with them a number of times just about what we're offering. And one of the things that really wrapped it up in the end is that we sent over our analysis of basically, so they didn't just think we were just trying to lowball them. We said, listen, this is the offer we're making to you, and it's not so much. It's because we have to meet these certain returns, and these returns to our investors, and this is how it's working out for us. And they had that, and they said, listen, if you pay your broker's commission, we'll do this deal. We said, okay. And that was where we got under contract.
Sweet. I love the patience there that you guys had the discipline to wait, because I think naturally as a salesperson, the broker's incentivized to get the sale done, and I've been in those conversations, and I feel like I'm being led down a path to slaughter, and I'm like, I don't have to do a dumb deal here. All right.
Yeah. And I wish I could take any credit for that patient, but I had the right team around me, and they were saying, like, listen, like, the numbers are the numbers. So just hang out, like, if there's no reason to do it, if it doesn't, and at least we had we understood to listen to them, and maybe without having those team members in place, we would have been into a deal maybe at the not at the best position, but at this, we got the number that we need to meet, and we're very happy with it.
No, that's great. Curious, how many deals do you think you looked at from the beers in the backyard to getting this one under contract?
This would be covering, so it would be Kentucky, North Carolina, and San Antonio, a lot. So I couldn't even put a number on it, but it wasn't under 10. It was, deals that, and if we said deals that actually we liked and we were making offers on, we probably made offers on about 15 to 18 deals in that time frame. But we probably looked over 100, and we learned quickly that we couldn't spend 3 days analyzing a property. We just started doing a quick formula, looking at the numbers, and using a couple different spreadsheets that others were using just to get a quick 10-minute cap. Like, this either was so far out of the box it's not going to work, or it was okay, we're somewhere close. Let's look a little further into it. And that's how we just started analyzing properties. So maybe we looked at 100 deals, but 50 of those right off the bat, in 10 minutes we just threw out and just said it's not going to work.
Right. No, I love to hear how many deals you actually do look at, in order to find a real deal, as opposed to deciding one day that you're going to buy an apartment building or a complex, and you drive out and you pull up and go, this is the one. Just
yeah, exactly.
doesn't work like that.
Yeah, we all wish, right?
Yeah.
Yeah.
So let me ask you. It sounds like your discipline paid off. Your patience paid off. What did you see? You mentioned that the property manager said that this one had some. I don't remember the words you said, but it sounded like there's some value add opportunities. We had
the luck that you have value add opportunities on a couple different sides here. The paperwork was so sloppy that rent increases over the last 3 years were basically tracked. They were tracked on a scrap piece of paper and a napkin. So when we actually got our due diligence beginning, the packet of information came over in a box, and it was so haphazard. And we had a great suggestion from someone along the way and said, put into your contract, the due diligence will not start until you receive all the items that you request from the sellers, and you give them written notice that those you've received all those items. So we had about a 25-day gap there of extra due diligence because we just couldn't get these items from the sellers. And so of a 45 due diligence period, if we actually had not put that clause into our contract, we would have had just 20 days left to actually just analyze this property, do our inspections and everything else. So that was a huge win for us.
That's awesome. I've never heard that, and I mean that's something that's going to be on my next offer, because that is, your clock starts as soon as you get agreement, and then if you don't get all that information and you're working to get that, you're essentially you could you could make a big mistake not having all the info there. So that's good.
Yeah, you rush. And what we had, it was just very interesting. And to this day, I still can't figure out the accountant, whoever the accountant was for them. He was some wizard that had some magical thing in mind. But they had 5 buildings split over 3 LLCs with one LLC just had the income for 4 of the buildings. One LLC had just the expenses and the laundry income for those 4 buildings, and then one LLC had the income and the expenses for the other building. Why it was tracked like this, how it was tracked like this, beyond me, beyond my context. Maybe someone out there is smarter than me that can figure that out. But that was part of our whole process of trying to figure out what the heck was happening throughout this complex here. On a level of being able to add value to the property, it's in an area that is saturated with apartments, and the vacancy rate throughout all these other complexes, because the property manager actually has a couple of the other ones that he was managing, was around. He wasn't managing this complex; it was managed by the sellers. But this complex that we brought was at 8%, and all the other complexes were at 3% all the way around. All the other complexes were charging between $75 to $100 more per units than this currently was charging per units. Same 1970s vintage style apartments, nothing different. The other apartment complexes were also charging just simple things like they had pet fees. They had a $300 non-refundable pet fee and another $15 a month for pet fees. We weren't charging any pet fees at this complex, and they actually had 10 units that had pets in them. So not only were they not charging pet fees, they had pets in 10 of the units when they weren't supposed to have any pets.
Right.
They have 2 laundry rooms, and the laundry rooms were down. And both of those laundry rooms are the only laundry rooms for all those apartment complexes all around. So it was just a lost chance just to add income right there. And there was another thing we're doing is we're actually doing a number of different utility efficiencies. We're replacing all the toilets. They're the old 3.8 gallon toilets, placing shower heads, faucets, and we're changing out windows. That's going to be some of the big things because it is an all owners paid property there. So some of the utilities were way out of context of where they should be for this property. So we saw that. And one of the last things that was pretty hilarious, we went there for the day of inspection, and they had of the 8 or 9 units they had that were down units, really 4 of them were rent ready. And just people walking up every day and wants apartments, and the lady who was their leasing agent or leasing manager was sitting there watching Dog the Bounty Hunter, and we're just more annoyed that we're there than renting out the units. So he said, okay, well this maybe isn't that hard. So you just have to get one person in there who wants to pick up the phone.
Wow. Isn't that funny? I mean, how easy it is to get comfortable and not really driven to drive the income there. That's awesome. Well, it's awesome for you guys that they didn't need a lot of work, that they just basically needed a tenant. That's huge.
Yeah, and a couple of the other units, of course, they still had the shag carpet and the appliances from day one. So we'll have that. We have some of those, but there was nothing major. The roofs had just actually been replaced a couple of years prior. Brick facade, the slabs were in good condition. So the heavies, at least for us, the heavies are in good working order, and that was very important for. It's not that we weren't comfortable with larger projects. You're just taking on a larger property out of state. Having other investment money, we didn't want to take on such a large renovation, and we wanted to make sure that the asset we were looking at is, and still one thing we're going to do is that it's at least 85% economic occupancy. So we were stabilized day one, where we weren't having to go in and just do a complete just turnover on such a large property and just be so far away while we're doing that. Got
it. Tell us a little bit about the financing. You mentioned syndication.
Sure.
How did you guys come to that decision? Tell us a little bit about that.
Another thing from mentors was that you find the property that works for the numbers, and then you find the financing that works for that property. And another great note, we actually, one of the things we did do prior to as part of our search for team members is we were talking to as many mortgage companies as possible, because each has their different prerequisites or requirements, and some are semi just T12 and the rent roll, and some are semi your complete background history since you were 3. So for that, we were very ahead of it, that we'd have a list of what was required. So when we did get the property under contract, we could put that list together pretty quickly instead of trying to find a mortgage company, because then that's going to eat up with your timeline, because the timeline does go quick. Once it does get started, it goes very quick from due diligence into the closing phase. So we looked at the property. Kevin, as I said, has dealt in on the brokerage side for a number of years, had a lot of relationships out there with a number of different financiers, and we decided on it was a loan that was due to the loan size. It was basically a small size loan through Fannie Mae, and it was a 7/6 arm that allowed us to roll some of the CapEx that was some of the big window replacements, some of the paving we're going to be doing for the parking lots, some of the replacing for the toilets and shower heads into the loan. And then beyond that, we syndicated part of the down payment and also some of the additional repairs and some of the fees we had in there.
Got it. And syndicating, I know there's a couple different versions of that. Were you dealing more with friends and family, or were you going out to unknowns and making sure they were accredited, or how'd you go about doing that?
It was all a learning process. We actually were, you were talking about a couple different ways, and those two would be like, there's the 504 and then the 506B and the 506C. It all can be very extremely complicated. But what I would say is that make sure you do get an SEC lawyer on your side, so you have them do the heavy work, because it's way beyond my scope. But we did choose the 506B. That allows us to bring in friends and family who may be sophisticated investors but don't meet that accredited fashion, which is $200,000 for the last 3 years, or $300,000 for the last 3 years if you're a husband and wife, and some fashion of $1 million in net worth. And so we went this route because we had been talking throughout to friends and family that this is something that we're looking into, and these are the returns that we're thinking about offering. And when we do find a property, it's something you're interested in. And we had a lot of people on our side that were like, yeah, it sounds like a great idea, and bring it back to us. And we realized we had enough for this property to go out to just our immediate network. And that was one of the advantages we went with the 506B. Going forward in the future, I know a lot of people do the 506C. Of course, the advantage with that is, you could put it on Facebook, you could shout it from the mountaintops. You can do a lot of different things with it. One of the big components is that it does deal with just accredited investors. And from that, when you do deal with just accredited investors, they have to meet a certain criteria. And that's a whole different platform that you're gonna jump into.
Got it. As far as the syndication model, do you have a sunset as far as a disposition timeline? What's that?
We underwrote it really to 10, just figuring here that we, worst case scenario, probably see some kind of correction in the next couple of years. Maybe not. Maybe we will. Who am I to tell? But our dispositions between year 5 to year 7, and we think we will be refinancing in year 3 is how we have it laid out.
Okay. And then do you and Pili, are you expecting them to exit as well, or would you try and retain it, refi the partners out, or?
What we've done here is that we're keeping the partners into perpetuity. So if we refi it out, especially on this first deal, we wanted to make it apparent to our investors is that we've been real conservative on this one. We really looked over a number of deals, and we wanted to say, like, we really appreciate you taking this journey with us, and we want to give more to the investors on this first one and allow them to stay in the deal if they so choose after we do refi out. And from that part, then when we do sell it, we would all be out at that point.
Gotcha.
Going forward in the future, as we're able to bring more on with maybe bring less partners on, the play is to keep these properties forever if we can. And that's the whole part of this larger multifamily, if you can build generational wealth. And someone said it, I was listening to something earlier that if you never sell something, you never lose money on the property if you never sell it, because you never realize that loss. So as long as you buy it right and keep allowing it roll to you, you can grow it forever.
Right. No, I always like hearing what the long term plan is. 'Cause I think sometimes a lot of times in
Yeah.
the syndication model, what I hear is more of kind of it's make returns for everybody, which is definitely why people get invested. But I think that sometimes I'm just kind of curious if people are thinking through kind of more of a long term strategy personally, or for their, like you said, generational wealth, as opposed to essentially rolling from deal to deal kind of thing there. So. Well, cool.
Correct.
Tell me a little bit about any hurdles with. I guess what I'm looking is for the operation out of state. It sounds like you pretty well vetted and you were familiar with the area. You mentioned you knew people in the area. You've vetted the property manager. Any challenges that you've encountered, or any lessons you could pass on?
In Indianapolis, I did. I actually, so I'll go back to that property. Just that was another out-of-state property. They were asking us for draws for some of the construction we were doing. It was a turnkey one out there, and I just so happened to be in Louisville and decided to kick out there. And I got there, and they were way ahead of me than the work was being done. And so you do have to create that comfort trust level out there, because if you don't have the right team members in place, they may be asking for milestones when that milestone is maybe still a month away. And there's a lot of things you can do. You can get pictures and everything else, but sometimes if they have these houses with the wrong pictures, you could be very far off from telling what it is. So video feedback and other points. That the thing with us that was a little, I guess, trying is if there was one thing that we're definitely going to do a better job is on the money raising side, just making sure the commitments are firm. And not to say with commitments, but everybody, you talk to people about some of this great stuff that's going on, people can be excited, but excited and I want to do it, and excited as, let's sign this and let's do this is two different facets. So we had some larger swings of capital right at the end, and it wasn't anything, bad. It was a couple people had some tax things come up for their points. They had started some businesses and other things that they weren't as liquid as they wanted to be at the moment. And then what we were finding is they felt bad telling us that they couldn't do it anymore. And so a month went by, and all of a sudden we thought they were part of it, and then they weren't able to do it at the end. So we had a little bit of scrambling at the end, but that's just part of it. And especially now, on your first larger ones, you're wearing more hats, and we're learning as we have more team members in place going forward for the next one that it will be a little more systematic, where you're kind of at the gun of what they're asking you for, especially some of the mortgage companies and other things. And it will be pretty funny, because sometimes you'll send people the same paper 13 times and they'll say they haven't got it, and you just have to keep sending it and just keep being repetitive with the process. But if you're, a couple member team, or even yourself out there doing it, that chews up a lot of your time when you're trying to really focus on the bigger picture of everything.
Right. Yeah, I'm curious. You'd mentioned offer 2.15 mil. Was that where you guys started? What I'm curious. How much did you guys end up raising for your through your syndication?
It was the better part over 700,000, and we finished closing on at 2.3 when it was all said and done. But our strike price, at our max offer was a little over 2.4.
Got it. In 700,000, how many partners did you have to?
I think we're 12.
12 partners. Okay.
Yeah.
Got it. Well, that's a pretty cool first deal. I mean, to 94 units and do the syndication. How long did it take you? You mentioned you had the 20-day lead time plus the 45 days. But so once you had the property under contract, was everybody? I mean, in 65 days were you able to close on the property? How long did it take?
It did get delayed a little bit. Some was on the seller side and some was on our side. At the last minute, they needed a new survey because the survey the seller had wasn't sufficient when it was all along. And the one survey guy, I guess, that was available was on vacation. So things happened that it was really nobody's fault. we were a little delayed on the Reg D part and of putting together the securities paperwork. And part of that is, I could say that you could always point finger, but like you need to really learn the right questions to ask. And sometimes you just don't know the right question to ask until something arises, and you say, okay, next time I need to ask that question. And that's a pretty big part of the picture. And going forward, we compiled a lot of things a lot of the errors we made, and you have a million things that can get you off track, but having mentors on the side, that allowed us to not get off the track too far, to say, okay, listen, like you did that, just come back over here and you'll be fine. But some of the things with the lawyers and with the SEC paperwork, we just didn't know the right questions. So there were certain timelines that got extended because we weren't asking certain things at certain points, and some simple paperwork we needed to supply to them, we weren't doing it at a certain time frame just because, for lack of a better word, we just didn't know too.
Got it. Well, I think there's a lot of lessons you learn in doing. It's one thing to read everything and listen and all that, but until you actually get in and there's live bullets flying, it's that's where the rubber meets the road, as they say. So
that's right.
Good. That's good. So what, you guys have anything on your horizon? I mean, this is a recent acquisition. Is there a next property that you guys or is there a time frame for doing another one?
Yeah, we have the team in place now, and that's the big parts here. Is the team is in place, and the team can handle more than we actually have right now, and those are two strong components. So we were actually in Kentucky 4 or 5 days ago now. So we looked at a number of properties there. Some we had offered on prior, and there's one property we just put an offer on a couple nights ago, and there's another one in our sites right now that we're just waiting for financials back. So
Sweet.
We like the area. Yeah, we're going to keep. Now that we had the 3 markets where we were targeting on, now that we have such a strong team in one market and we have our foot in the ground, we're going to double down in that market. Good.
I like it. If you were going to give some advice to investors or potential investors looking to get into multifamily, is there any lessons you've learned here that you could share and some words of wisdom?
You're going to make mistakes. That's okay. You're definitely going to make mistakes. Sometimes people are so worried about mistakes that they just don't act at all. And if you think about your life day in and day out, you make hundreds and hundreds of mistakes. Maybe you don't keep to your diet. You don't get up in time. You forget to pay your phone bill for whatever. You just all kinds of stuff that you correct easily. It's not the end of the world. Nobody comes and rips you from this and sends you off on a plane somewhere. It happens, and it's the same thing with real estate. But if you can surround yourself with the right people, it will really help you to make stronger choices and help you to get to the finish line a lot quicker. But you do have to take the action steps. If they're going to give you these steps and say, this is what we did, it worked for us. And if you say, okay, cool, and just say, all right, I'll keep thinking about it, well, then you're not going to get to your goal.
I like it. That learning by doing and learning from your mistakes, I think there's a lot of wisdom in that. That's great. Jason, I've enjoyed our talk here. Is there anything that we didn't go over that would be useful for the listeners in this?
No, I think we've covered a lot. So I really appreciate you having us on. I'll add one thing that we just found that I think could be interesting, because not a lot of people have looked into it, is that there's a number of green initiatives out there that people can take into use for their property. And we were told no, that these were not available in Kentucky, like, I don't even know, 20 times, but we kept asking the question. We found a program that may be very beneficial for our property. So I would look into it more if other people have properties, because it can help a lot. We're still on the new side for me to know all the facts to it, but we did get the door shut on us about 20 times. We finally found a little in, and this will be something we're very excited to see where it goes.
Sweet. No, that's definitely some good advice. I know it's funny, there's all sorts of opportunities out there, and I think if the majority of people just stay on the main path and aren't looking, off the path, they'll miss them. Yeah, except for people like you that are curious and keep asking, you'll find those opportunities there. So good for you.
Yeah. My wife yells at me because I'm always on the shiny thing. So I got to keep my focus on. And that's why I have her and Kevin keep me
Yeah,
on track.
that's good. What's the best way for the listeners to find you and follow you and your? I know you've got the podcast. Why don't you tell the listeners here how they can find you?
Sure. Myself and my wife Pili, we have the REI Foundation podcast with Jason and Pili. You can find us on iTunes, Stitcher. Love for you to check us out over there. You can also find out more about us at oakcappartners.com or info at oakcappartners.com. And if you want to see some more about house lifting, you can look at WA Building Movers. A lot of stuff going on out there with the changing in climate, as we talked about a little bit ago.
No, that sounds good. Well, Jason, I want to thank you again for taking time today and sharing your story. And wish you all the best. And let's definitely do this again. I would love to hear about your next one and possibly even getting you on here and talk a little bit more about that flood and the building moving. Definitely be good to do. So
we'll be happy to. Thank you.
Got it. So for our listeners, if you like the show, share it with somebody who you know that would like it. That's what we're all about here, is to learn and share. And don't forget, if you're on LinkedIn, be sure to check out our group, Commercial Real Estate Pro Network. That's all we've got for you this week. Thanks again for listening to Commercial Real Estate Pro Network's CREPN Radio.